Okay, and then let's look at violin. Let's look at violin. So what do we have here again? The principle here. My budget was 66,000. We should never have touched it. Budgeted output was 10,000 units. So I can find, if you like, my overhead absorption rate per unit, and that's £6.60. Yes, and that's what I should be putting in for every unit with every journal. Now, what happens? We actually make 10,200 units. So you would have gone debit 6.6 times 10,200 units. So 6.6 times 10,200 units is 66,000. Sorry, is 67,320. Yes, 320. So you would have had, I mean, why not? Let's do some T accounting, right? Why not? 67,320, that's the expense, fixed overhead expense, and the fixed overhead accrual or control account or whatever you want to call it, 67,320. So that's the first, that's what you've put through in this journal. Um, then the question goes on to tell us that the fixed overhead expenditure variance, so the difference between the budget and this thing, the budget and what actually happened is 3040. So you had budgeted to spend 66,000, but what actually happened was this, the 30, the difference. So the actual event, the actual cost plus 30, I think it's important to understand the language, was 69,040. Um, sorry, um, the actual fixed overhead production, the difference between fixed overhead, the fixed overhead expenditure means just what's the difference between the budget and what actually happened? That's all. Just literally, it just is. It's just, well, that's just the language for that. So that's 3040. So the actual fixed overheads were 69,040, if you like. Um, and the and that's what you and that's actually what happened. Now, when you were doing your account, you would have compared this figure with what you put in your accounts, because in your accounts you'd have put this, you would have said, oh, there's a difference between this thing and this, right? Because that's your budget. Yes. So you would have said, oh, the variance here is an adverse variance of the difference. So I've got in my account 67,320. That's what I can see in my accounts, thanks to all my playing around with the numbers. And this. So you would wake up in the morning and say, oh, there's a difference between these two. And how did I get that difference? 67,320. And you would say, oh, I have a variance of 1720, and which is adverse. So what we're trying to do is sort of understand this figure. So what you would do in steps is to say, okay, you know what? Let's first of all bring this down this way, back to the budget, if you were asked that question, and this would have been your volume variant. You'd have said 67320 down to the budget, and that would have been 67320, because we're reducing a cost. We basically put in too much. We basically overabsorbed 67320 minus 66,000 is 1320. So you'd have said, oh, that's 1320 favorable. And then you just said, and then we went from 66,000 all the way up to this, which was 3040 adverse. So you'd have said the combination of the two of them is what gives you, you would now know that the combination of the two, this adverse and this favorable, is what gives you the 1720 adverse. So language is so important. The fixed production overhead variance, which is what it appears like when you prepare your accounts, is this thing here. But when you break that up, you break this up into an expenditure variance and a volume variance. And what is the volume variance? Simply taking this thing back to the budget. And then expenditure variance is simply comparing that budget with what actually happened. What actually happened. Hope that's clear. This one has always tended to give students a bit of a headache. I don't know, but hopefully by doing these questions, the ones I've done, that covers a lot of the ideas. Okay.